Bruce, thanks for sitting down with Livewire to do a rapid fire interview. First question, what's the biggest issue being debated in the Elston war room right now?
The economic outlook. You've got increasing interest rates, you've got a stretched consumer, you've got valuations that in some instances are a little high, and then those that aren't high, there's perceived to be an issue with the company itself.
Bruce, what are the core principles of your investment philosophy at Elston?
We have 6, believe it or not, Chris, so have you got half an hour? We'll run through those. Yep. The first one is a proper diversification, and I might just give context around proper diversification. And if you think about the Australian index, it's extremely concentrated to the big bulks and the big 4 banks, so proper diversification is taking a major position against the index that you're judged against, but diversification is very important for consistency of results longer term. We have liquidity, so every position within the portfolio has daily liquidity. We think that's very important from an end investor's perspective. They may have a call for the money, so we do provide liquidity. Third is after-tax management. It varies how much you can do there, depends on the structure it's invested through. We go all the way from IMA, SMA to unitised, and you get less flexibility the further you go along there. The fourth is we look at both value and growth, so that leads us to being a style neutral manager. The fifth is we take a long-term investment perspective, and that's very much against what's happening in the markets today, which is short-termism is rife. And the last one is avoiding permanent loss of capital. So if you put it in a company perspective, it's profitable through the cycle and a reasonably strong balance sheet.
Bruce, I know you just said you take a long-term perspective. I'm going to be really annoying and ask you what has you most excited for the next 12 months?
Our positioning towards healthcare would be what it is. It's had several headwinds coming out of COVID, and some still persist. In fact, those headwinds are lasting a little longer than what we expected. But certainly we think there's a lot of things to like about it. They're reasonably defensive. They've got demographics in their favour. They do have growth drivers, very strong market position. For the first time in a long time, we're overweight healthcare because they stack up on a valuation basis.
Bruce, what do you think is the biggest risk investors are ignoring right now?
It is probably an elongated interest rate cycle where they stay higher the longer. That flows through to how assets are valued, and we think in certain instances valuations are a little high at the moment.
Just following on from that, given markets are at ritzy levels and those valuations are a little bit challenging, how hard or easy is it to find opportunities right now?
We think there are plenty of opportunities out there, but usually you're going down the road of something less popular. Right. And less popular might be in the form of less sexy, so not AI, for example. Yep. Less popular may also be there's perceived to be a structural headwind or a company-specific headwind with the business. And through research, we will take a position if we're confident that the market's got that wrong.
Bruce, my favourite question, as a seasoned stock picker, what gives you more satisfaction? Is it the hunt for the opportunity or the reward when you get it right?
Well, I think you've got to be curious to do the job that I do, and so I think the result is just a function of the hunt. It's endlessly enjoyable trying to work out how companies do it. You look at business principles are broadly the same regardless of the industry they're in, and you look at different companies' takes on how they go about it, and that to me is fascinating.
Bruce, thanks for sitting down with Livewire.
Pleasure, Chris, thank you.